started working, so I'm hoping they'll hang in there for us. Somehow magically the guy couldn't fix it. Yeah, it kind of fixed itself. Typical computer stuff. We were just doing a problem downstairs and without a blackboard. Which one are we doing, guys? 812. Let's do exercise 812. Okay? Let's take a look at that. On page 455. So this is inventory errors. Let's try that one. Okay. I think the way I'd approach something like this, page 455, exercise 812, I think I'd get myself organized and lay out the years and what's going to be changing so I can compute it pretty easily. Don't try to do these in your head. The first year you can do it in your head. Second year gets kind of tough, and each year thereafter just kind of drives you crazy. I think I would set it up something like this. I happen to know that assets, which will be the inventory in this case, equals liabilities. There's going to be nothing wrong with liabilities, plus equity, and whatever's wrong with the assets has to be what's wrong with the equity, wouldn't you say? Okay, and then I'd go ahead and I'd say, all right, fine, I've got 2009, 2010, 2011, 2012, 13, 14? All right. Okay, so we're going to have all those years, aren't we? Okay, and I know that what's wrong with assets each year has to be what's wrong with equity. I'm going to start there, right? Because it makes it less confusing, I think. Okay, and then, of course, you got an income statement going, right? Revenues. And the revenues are all okay, right? They're fine. You see the problem? The revenues are okay. Less cost of goods sold is going to be gross profit, right? You know how to calculate cost of goods sold? Beginning inventory plus your purchases, net purchases really, is what's available. Am I right, guys? Subtract your ending inventory will give me cost of goods sold, and then if I subtract these cost of goods sold, right, from the revenues, that's going to give me my gross profit, and then if I subtract my operating expenses from that, that's going to give me my net income. Everybody agree? So whatever gross profit's off by, seeing as operating expenses are going to be fine, right? There's nothing in the problem about operating expenses. The net income and the gross profit are going to be off by exactly the same amount. And questions will ask you about one or the other, right? What's wrong with cost of goods sold? What's wrong with gross profit? What's wrong with net income? Okay? So that's it. And then it's going to be all those years going across. Year 9, okay? 10, 11, 12, 13, 14. And after you get this thing going, it's just not a very big deal. What's wrong in the first year? Okay. Assets are overstated by 3,000. I don't know about you, but I think that's going to make equity be overstated by 3,000 because liabilities is fine. And I know debits equal credits. It's kind of nice, huh? Okay, revenues are fine. Beginning inventory we assume is fine if they said nothing, right? Purchases every time is fine because they said nothing. Everybody agree? So I don't know why I didn't put 9 over the first one, but oh well. All right, anyway. I guess that's just my form. All right, anyway, so what do I know is wrong? Beginning's okay, purchases is okay, available's okay, ending inventory is what? Too high by 3. I subtract 3 from what a correct number, right? 3 too much from a correct number. What does that do to cost of goods sold? Understated by 3. Everybody agree? What does that do to gross profit and net income? Overstated by 3. I don't know about you, but I think that's what caused this 3 over here. You agree with that? When I close that net income that's too high by 3 into equity, that's going to do it. So let's do retained earnings, which is part of equity here. And what I've got is 3 too much in retained earnings for the first year. Does everybody agree with that? It's true, isn't it? That's what causes the equity to be too high. Now here's the trick. It's not a very big trick, but it's the trick. This ending inventory for the first year is what? Beginning inventory for next year. That's it. So it's too high by 3. Does everybody see what I did? Let's pull this up there. Okay? The beginning's too high by 3. If the ending one year is too high by 3, guess what? The beginning of the next year is too high by 3. Let yourself think. Okay? So purchases is okay, probably. Didn't say anything. Available's too high by 3. Everybody agree? And what's that going to do to your cost of goods sold? If you subtracted the right ending inventory from it, what would that do to cost of goods sold? guys? Available is too high. Subtract the right ending inventory. What would it be? It'd be too high by 3, which would cause what to the gross profit and net income? Too low by 3, and look at that. They corrected, self-corrected between the 2 years. 1 year's too high by 3, the next year's too low by 3, of course, right? If you had ending inventory correct. Everybody agree? And everything would be just fine. But that didn't happen. What did happen? Ending inventory is what? It's overstated by 9. So now I subtract too big a number, right? By 9. What does that do to my cost of goods sold? Makes it too low by 9, doesn't it? So what's wrong with cost of goods sold? If one thing's making it too high by 3 and another thing's making it too low by 9, what's wrong with it, everybody? Too low by 6. So the same thing with the net income. My net income is too low from the first error, right, by 3, and it's too high by the second error by 9. And what's the combination? Too high by 6, isn't it? Well, what was wrong with the assets? Too high by how much, guys? Assets, inventory. It was too high by 9. What has to be the case with equity? It's got to be too high by 9, doesn't it? Doesn't assets have to equal liabilities plus equity? If assets are too high by 9, equity's too high by 9. We're right, aren't we? Okay, how'd that happen? Okay, look, I'm overstating income the first year by 3. I'm overstating income the second year by 6. What's 6 plus 3? It's 9. Overstatement of 9 at the end of the second year. Everybody got it? That's what caused that one. Get organized. Okay, don't try to do this in your head. It'll drive you crazy. Okay, what happens now it just keeps rolling forward. What happens in year 11? Beginning inventory is what? Well, at the beginning. Yeah, you got to bring this 9 from here up here, right? It's overstated by 9, isn't it? What does that do to available? Overstated by 9. What's that going to do to cost of goods sold, everybody? In year 11. Overstated by 9. Everybody agree? So available is too high by 9, right? Cost of goods sold is too high by 9. What's that going to do to your gross profit? You're just correcting the prior year's 9,000 error, aren't you? Right? What's it going to do to your profit? Too low by 9, huh? Right? 1 year was too high by 9, the next year's too low by 9, of course. The years counter each other, right? Self-correcting. So if there was no error, we'd get rid of the 9 problem, and it'd be 0 on the assets and 0 on the equity, wouldn't it? But what happens the next year? What do we have in year 11? Ending. Understated by 11. Okay, you're subtracting 11 too little. What'll that do to cost of goods sold? It's understated by 11? It'll make it too high, won't it? So I've got 9 too much from the first error, and I got 11 too much from the second error. So when we were downstairs, I think we put this backwards. Yes, we didn't really quite get that far. So what do we have? Cost of goods sold is too high by how much? 20. Okay? And gross profit there is too low by, therefore is too low by what? 20. Gross profit net income too low by 20. Okay? Everybody see it? So you got to be really careful which direction you're going, don't you? Okay? So now what will that do, that 20? I'm going to take it over here and I'm going to put it in retained earnings, and it's too low by 20. So if we were too high by 9 and we took 20 out of there, right? Too low by 20, what do you think? Too low by 11. Well, what did we say the asset was, the inventory? It's too low by 11, wasn't it? Guess what? Equity's also too low by 11. Of course it is. It's got to be the same, right? Getting there? Are we getting there? You got to pound through a few of these, don't you? Okay? You can bet I'm going to give you something like this. And so are they on the CPA exam. The odds of getting through the CPA exam without being able to do this is slim. Okay? Right? You got to be able to handle errors in financial statements. And inventory is worse than an error on depreciation expense. Why? Because ending inventory becomes beginning the next time. Right? Every other account, it's just one error at a time. Okay? Here it creates two of them. Then self-correction Do we need to do another year, or are you okay? One more? One more? Okay, we'll stop. Let's do 12. Do year 12. Takes too much time to do too many. Okay, we'll do year 12. Give us some room here. Okay, so what's wrong with the beginning inventory, everybody? It's too low by 11. That's what it was, right? What's that going to do to your available? Obviously too low by 11. What's that going to do to your cost of goods sold? Too low by 11. Everybody agree? What's that going to do to your net income? Last time it was too low by 11. Guess what? It's going to be too high, isn't it, by 11? Because you're subtracting, I'm sorry, because you are adding too little from the beginning inventory, so available's too low, right? So therefore, cost of goods sold's too low. It's going to make net income and gross profit both, of course, too high by the 11. It just reverses. And then what do we have at the end of that year? No error at the end of this year? Okay. So if it's 0 here, where are we at? Just the 11, right? Everybody agree? Okay, so my inventory is what? Okay, isn't it? No error. What must be the case with equity? No error. Well, wait a minute. How'd that happen? It was 11 too low, but oh, we're putting 11 too much in, aren't we? You put 11 too much in, and you had an 11 too low. What's the deal now? It's fine. Ta-da. So the errors reverse. And then they kept going, but it just doesn't work. Okay? So, by the way, the net incomes of all the years are wrong, but if you add that group of years up, guess what? In total, it's right. Right? For the total of all the years, it's correct, isn't it? There was no error at the beginning, and there's no error at the end. Guess what? All the net incomes must be in total correct. Do we still care? Well, yeah, they might be smoothing their income, right? Or people are making investment decisions based on wrong numbers. Okay? Sure. All right. Everybody good with that one? Practices. Okay? Practicing. Okay. And there are a number of them that do that. Let's see. Let's take a look. Another one we did here earlier. Dollar value life. Okay, now the deal, what's going to happen is we're going to do retail inventory methods in the next chapter, right? Which will be on a different quiz. Okay, so we're going to do retail inventory methods. And what that is if you're a retailer, and you're selling your product to the general public, the product is sitting in the bin in your store, Kroger, right? The product's sitting in the bin in your store, or Walmart, right? And right on the bin is the price that you're selling it for. Would it be pretty easy to find the price you're selling it for? Oh yeah, it's right there. So you count, right? And then you price the inventory out, cost the inventory out at sales price. Then what we do is we convert the sales price to cost. But then we also have a method which is called, and that's our estimate of inventory. We also have retail dollar value, LIFO method. So we do this retail and convert the cost, and then we have to figure out the layers of LIFO inventory. So get this down. It's not too bad in this chapter, but it's crazy in the next one. Okay? Turn your head inside. So let's do a dollar value LIFO problem. Once you figure this out, those of you who were here, it looked pretty easy once you got it, didn't it? Anyway, it looks pretty easy after you got it, right? It's not a big deal. Which one did we do anyway? It was 20, did we do 25? Yeah, let's do exercise 26, page 459, so they see a different one. Okay? E26 on page 459. Okay, now what we're going to do with this is this is companies that want to use LIFO, but they don't want to really keep track of all the layers. And they don't want to keep track of all the inventory items. Before there were computers, people really loved this method, but there are still companies using it. This is one of those things, if you know how to do it, you have a big advantage on the CPA exam because your competition is not going to. Because most people would just skip this, we just let it go. But it gets down for you how LIFO really works too. So that's valuable, okay? Even beyond the few points you get on the CPA exam from this thing. Okay? So exactly how does this stuff work? What's the deal with LIFO? Last in, first out. Which ones do you sell? The most recent purchases. Which ones do you keep? Old stuff, right? That's going to be true here, but we're going to keep our inventory by year. Not by items, by year, okay? So what we do each year is we count the inventory and we price it out at year-end cost, which is easier to look up than going back and finding when you bought it and have all the different layers, right? The old prices from back in years. So we're just estimating what LIFO would be, basically. Okay, so look at what they start with here. For 2010, 2011, 2012, and 2013, I guess, and 2014. What they gave you is year-end inventory at current cost, right? That's at year-end prices. That's more than you paid for it. Everybody agree? You got some old stuff. It's certainly more than LIFO would have been, right? Because with LIFO, you're keeping the real old stuff. Okay, so I've got 70,000 here. Everybody see it? I'm just copying from the problem. 90,300. 95,120. Tell me if I screw something up. Switch problems or something. 105,6 and 100. Everybody agree? But that's year-end dollars. Let's find out what it would have cost in the base year, the first year, to buy these. So what I've got here then is a price index, and that could be the retail price indexes, consumer price index, could be wholesale price index, or it could be just an index on your inventory or for your industry, right? So what would it cost me now to buy this inventory? So in the base year, it's 100. A dollar is a dollar because that's where I started, okay? So this index represents how much it would cost to buy the inventory now, okay? Well, at the end of the first year, it's base, so it costs a dollar to buy a dollar, okay? 100%, okay? The next year, what does it say? It costs $1.05. Costs have gone up 5%. That's it, okay? It costs 5% more to buy an inventory, that same inventory item, okay? So it's 105, right? And then the next year, what was it, 116? 120, okay? So these guys have inflation, don't they? 125. Everybody see it? So what I want to do is find out what it would cost in base year dollars. Okay? Everybody good? All you got to do is divide in. So this is base year. 1 divided into 70 is still 70. No kidding. What's 1.05 divided into 90,300? Somebody give me that number. That's what it would have cost in the base year to buy it. How much? 90,300 divided by 1.05. Quick, go. Be here forever. 86,000. Thank you. The next one, divide 1.16 into 95,120. What's that? 82,000. Everybody got it? I'm just getting the base dollars. What it would have cost in 2010 to buy each of those. Got it? Okay. Take 101.2 and divide it into 105.6, and what do you get? 88,000. Okay, it would have cost 88,000 if I'd have bought them in 2010. It cost 105.6 now, right? To buy it. Okay, and then the 100 divided by 1.25? 80,000? Okay, good. All right, then what happened each of these years? Okay, what I want to do is I want to get what the balance sheet inventory would be, right? For calculating my balance sheet inventory and then also cost of goods sold as a result, right, guys? What's the inventory going to be at the end of 2010? So my financial statement inventory here, what's it going to be? Well, I started the base year 70,000, 70,000, 70,000. So the first year is just 70,000. Does that make sense? It's just that, right? There's no inflation, right? 70,000. So this is a 2010 LIFO layer, okay? The 2010 LIFO layer is 70,000. Everybody got it? You can either increase the inventory or you can decrease the inventory, of course, right? What happened to the inventory in base year dollars? It was 70, now it's 86. Do they have a real increase in inventory or a decrease? Obviously, it's an increase, right? What's the new layer in base year dollars? How much more? 16,000. But I didn't buy those in 2010. I bought them in 2011. So what do? Inflate them at 105, right? Because those I bought this year. I bought those in 2011. Cost $1.05 to buy what a dollar did in 2010, right? I've got 86,000 in 2010 dollars, right? So how many of those were bought in 2011? 16,000, because I have an increase, right? In terms of base dollars from 70 to 86. I got 16,000 increments times what? 105. 1.05 gives me how much? What's that new layer? What is 16 times 1.05? 16.8. That sounds right to me. That's right. Guess what? That's the 2011 layer. Okay? So now I've got 70, right? Plus 16.8. So what's my year-end inventory going to be at the end of 2011? This is my financial statement inventory for the first year. Here's my financial statement inventory for the second year. How much is it? 70 plus 68 is 76,800. We are brilliant. Oh, it's 16, 86,000. I guess I wasn't brilliant. You guys are. 86.8, huh? It's the 70,000 plus the 16.8, huh? Two layers. Which ones am I going to sell first if I deplete my inventory? It's LIFO. The last one, right? The most recent year. I'm going to keep that earlier LIFO layer, that beginning layer, forever, maybe, right? If I never deplete it. Everybody good? Okay, what happens the next year? It goes down by 4, doesn't it? So now what's left? The two ways you could do it. You could take 4 off and subtract it, right? 4 times what, though? It's not 116. There's not going to be any 2012 layer at 116, is there? Because they didn't increase it. That extra, the 12 that I have left, 70 away from the 82, I bought that at 105, didn't I? Yeah, because I'm depleting the 2011 layer here, aren't I? Everybody agree there's no 2012 layer because I'm depleting 2011. There never will be a 2012 layer. Okay, so what happened is it went down by 4. That's one way. Or you could just say this 16 layer here is now 12,000. You got it? It's now only 12. It's 4 less. 82 less the base year at 70. Okay? So now what? It's 12,000. I bought at what? 105. What's 12 times 1.05? 12,600. All right? Everybody see it? So now my 2011 layer is not 16.8. It's how much is left? 12.6. Everybody see it? So how much is my ending inventory going to be? 70,000 plus 12,600. Everybody see that? I just depleted part of it. So what's my financial statement going to be at, okay, this was a financial statement at 2010. This was 2011. What is it going to be at 2012? Notice there's no 2012 layer, but at the end of 2012, what would I have? 70 base year plus 12.6 is 82,600. Got it? See what's going on? That's my 2012 financial statement inventory. Now let's stop a second. Make sure everybody's there. See what's going on, everybody? Not bad, is it? What you could have done, of course, is take 4,000 times 1.05. That'd be 4,200. Subtract 4,200 from the 86.8, and you get the 82. Yeah, 4,200 away from 86.8 would be 82.6. How about that? So, okay, get that way. Okay. After you do these a while, you can sort of do them in your head. Yes. Because there's no layer for 2012. How much did I increase the inventory in 2012? Not at all. It went down from 86 to 82, so I have no layer from 2012. I've got a 2010 layer of 70,000. I got a 2011 layer left of 12.6. And no layer at all from 2012, and I'm never going to have one. And what hangs this up is, well, wait a minute, in 2012, it doesn't matter. You didn't buy any inventory in 2012. You didn't keep any inventory. Remember, last in, first out, you sold everything you bought in 2012. Right? No layer. Did you get there? No layer from 2012 because I did not increase my inventory in base year dollars. I really got rid of some of the prior year even. So for 2012, there is no layer. 0 for 2012 layer. Okay? So I got a 2011 layer here, and I got a 2010 layer, and that's it. Okay? Now, when I start selling, if I reduce my inventory again, which ones am I getting rid of? 2011 or 2010? Which goes first? 2011, because it's last in, first out, okay? But before that, of course, anything I buy this year goes. But what happened this next year? They have a new layer, don't they? So I'm going to keep the 70,000 from 2010, I'm going to keep the 12,600 from 2011, and I'm going to add how much? Six? Yeah, 82 to 88, 6,000, but that's in base year dollars. That's what it would have cost back in 2010, I'm sorry. That's what it would cost in 2010. What would it cost in 2013 to buy those? What do you have to do to it? Take it times what? 1.2, because that's their index of that year. What would it have cost to buy that 6,000? Well, it would have cost 7,200, right? Guess what that's going to be? That's going to be my 2013 layer, okay? So now look what you got. You have a 2010 layer for 70,000. Everybody agree? You have a 2011 layer left at 12,600. You can't get it back after you sold it. And you have a 7,200 layer from 2013, nothing from 2012. Okay? We keep track of these layers. Which one am I going to sell first? Obviously, the 2013 layer. How do I get my inventory from my financial statement at 2013? On the financial statement. What's it going to be? What am I going to add up? The 70 I started with, right? Plus the 12.6 from 2011, right? That's going to give me the 82.6 plus what? 7,200 more. So if you increase it, you can just add it, right? You can take the 82.6 and add 7,200 to it, and what do you have? 89,800, which of course is a 70,000 layer plus a 12.6 layer plus a 7,200 layer. Got it? Each of those layers is there at the year-end dollars for that year. Okay? And then what happens? Goes down by 8, huh? What goes away here? This 6 is gone. The whole 7,200 layer got sold, right? Because that 6 is gone there, isn't it? What else is gone? Yeah, 2,000 of these 12 is gone. So what would that be? What will it leave me? 10,000, right? So what I've got, this layer goes away, and what I have left is 10,000 of it. Does everybody see that? The 12 gets 2 out of there, right? Because if we went down by 8, everybody see that? If you went down by 8, and the layer for 2013 was 6, that whole layer's gone. And then you got rid of 2 from the 2011 layer. Everybody agree? No, 2012 layer, I'm sorry. I lied. 2011 layer, we have no 2012. So yeah, we got rid of 2 of it. So there's 10 left. What was the index at that time? 1.05. So it takes 105 times 10,000. What is it? Told me that before, 10.5. So you see that layer from 2011 goes down from 12.6 to 10.5. So now this is my layer from 2012, 2011, I'll get it out yet, okay? My layer from 2011, that's all that's left of it. Everybody see that? So now what do I have? I've got 70,000 from the base year, right? How much do I have from any other years? Just 10,000 here, right? 70 plus 10 is the 80 we're at, so just the 10.5. So how much is 70 plus 10.5? 80,500. There we go. That's the 2014 financial statement inventory.
So you could also just subtract the 7,800 and subtract 2,500.
Yes. I'll get you exactly the same number. You got it. Okay? Okay. We went, well, we went down by 8, right? That killed off this 6. And I need 2 more. So I got rid of all the inventory that I added in 2013, and then I needed to get rid of 2 of this inventory from the year before. I just keep working back. As soon as 1 year is gone, I go to the year before. So what I have left is 70 from the base year, right, and 10 from the next from 2011, second year, right? Because that was 12, and now it can only be 10 because we only have 80 left in base year dollars. That's the 80 composed of, right? 70 from the base and then another 10. But it'd be the oldest 10, right? You got it. So we had to take the 12 down to 10 because we only got 8. Okay? Are we good, everybody? You can do this? Maybe not yet, but you will be able to, right? Okay. I have total confidence in you. Actually, I do have confidence in you. The only thing with you folks is I wish I could, because you're really good, I wish I could get you to do it all the time. I don't know what the deal is. You got to do it all the time. You got to work all the time. It makes a huge difference. Can't put it off. So let's take a look at a few things. I want to mention to you. You mentioned a couple things from the chapter. Take a look. Obviously, read everything. You guys are good with the difference between perpetual and periodic. We talked about it before. You did the principle. We talked about it in chapter 3. Take a look on page 419. They lay it out there for you. Be able to handle those entries. Hope that I give you something like that. Wouldn't that be cool? How to handle it if it's perpetual? Guess what? If you're perpetually keeping track of it, when you buy inventory, what do you need to debit? To keep track of how much inventory you have. How about inventory? How about periodic, when you're not keeping track of how much you have? You can debit a purchases account, right? You're just going to figure out how much you have at the end. What do you do when you sell it? Credit inventory if it's perpetual. What do you do when you sell it if it's periodic? Nothing, right? And they show it to you there. Okay, everybody good? Sale gets recorded exactly the same. Okay, no problem. All right. Basic ideas in inventory valuation. Okay, so let's talk about this truck, the next sheet, on page 421. High-tech truck. Look at the general rule. This is really pretty good. Guidelines in determining ownership. Whose inventory do you want to put in your balance sheet? Yours or somebody else's? Stupid question, right? Okay, I want mine. I don't want somebody else's. But the problem is, I might have inventory in my store that doesn't belong to me yet. It's there on consignment. I might have inventory that does belong to me in somebody else's shop. Got the idea? It might be in the truck on its way to me, and I might own it or might not. It might be in the truck on the way to my customer, and I might own it or I might not. You got to be able to figure it out, okay? All right? I might have even sold it to somebody and they have the right to return it to me if they feel like it. I didn't sell it then, it's still my inventory. And I also don't have a sale, by the way. And therefore I don't have the gross profit, I don't have the net income. You got the idea on this, you guys? Okay, so let's look at this. What does FOB mean? Anybody do anything with freight? Free on board. It's free on board. What does that mean? It's telling you who's going to pay the freight, who's going to insure it, take the risk of loss. Right, guys? Okay, who's responsible for this stuff? It's telling you who owns it. Oh, FOB shipping point. What would that be? When I ship it to you, it becomes yours. It's no longer mine. I would take it out of my inventory right at that point. Put it into cost of goods sold. I'm using perpetual. Got it? Take it out of my inventory. I sold it to you. What if it's FOB destination and I ship it? It's still mine until it gets delivered. Right? Don't take it out of your inventory. Okay? And we'll have questions that ask about this. Okay? It's real common. Okay. How about on the other side of the deal? I'm buying it. FOB shipping point. You ever buy a computer online? Guess when you buy it? When they ship it, it's your problem. If it's damaged in transit, it's your problem, not theirs. They have power, you don't, they're taking it. Right? So who's taking the risk? You are. Okay? On most things you buy online, you're taking the risk. They're not, by the way. Sometimes they do, right? But a lot of times they don't. Okay? And the freight company might take the risk too if it's insured. True? Okay? So anyway, what if I'm buying it and it's FOB shipping point? It's mine. What if it's FOB destination I'm buying? It's not mine until it gets to me. That's it. That's simple. Okay? Consignment goods. If it's consigned out and it's mine and I consign it out, I put it in the store. I make these stupid little lighthouse trinkets that my wife buys. Cost a fortune. Okay, anyway, I don't know what they cost. Anyway, she buys these lighthouses. Someday they're going to be worth a fortune, right? Collectors. Yeah. Anyway, so you got these lighthouses. They're in the Hallmark stores, right? gift stores and stuff. They don't own them. They don't buy that stuff until when? They sell it to my wife. It's just in their store, but it's not theirs. Who should have it on their inventory? Whoever produces it, right? Okay, that's how you get them to put it in the store. Finance their inventory for them. Okay? So lots of the stuff, if you ever do a Hallmark store, it's really annoying, right? Most of the stuff in the store, they don't know. It doesn't say Hallmark on it, it's not their future. Right? That's the way it is. Okay? So if it's consigned out, it's still mine. What if it's consigned in? I'm Hallmark, and they say, give it to me. What's the deal? It's not mine. I'm not going to include it in inventory. I have to separate it. Imagine counting it and costing out and everything. Right? Which is yours, which isn't yours. Okay, so know that one. Sales with buybacks. What does that mean? I sell it to you, and I agree that I'll buy it back if you can't sell it. I didn't sell it to you until you sell it, right? It's like assignment or something. So that's the sellers, not the buyers. These are hard to identify. Sales with a high rate of return. What's that? Yeah, I convinced you to buy a whole bunch. Yeah, and, you can return them to me, right? That's almost like a buyback, isn't it? Right? Did I sell them? Nah, not if it's too big and I can't estimate it. What if it's pretty good size, but I can't estimate it? You guys know about Nordstrom's, right? Nordstrom's is really good about letting you return stuff. They're really known for it. They built their reputation that way. If you don't like it, you can return it. If it wears out too fast, you can return it. We don't care. If there's anything wrong with it any time, you can return it. Okay? What's the deal? Gives them a high quality edition, right? What happens? Can they record those as sales? The answer is yes. They record it as a sale, and then they set up what? Sales return allowance. You got it. Okay? And so what would the entry be? They go ahead and debit, cash, or accounts receivable, right? For the full amount of the sale and credit sales. And then what do? Because they know they're going to get a whole bunch back. Debit what? Yeah, if they had gotten them back by now, they debit sales, returns, and allowances. That's that contra sales account we did, right? So sales less sales, returns, and allowances is the real sale. So they estimate the sales, return, and allowance, but you have to credit something. They haven't paid you yet, right? They haven't returned it yet. Okay, they haven't returned it yet. So what do? What do you want to call it? You said it right. Allowance for sales, returns, and allowances. No kidding. What kind of an account is that thing? I have an account receivable, but I don't think I'm going to get it all. What's that? It's a contra asset, contra receivable. So what I'd show is my accounts receivable less my allowance for sales, returns, and allowances, less my allowance for doubtful accounts, for bad debts. Got it? Okay? So it's a big number, by the way, for them, right? Because they expect a lot back. Okay? But they think they get more sales and more profit, right? For their stuff, right? So think they get more sales and more profit because they have this return policy, They can estimate it, though. They're really good at estimating because they've been doing this forever. What if you can't estimate it? Don't record the sale. Got it? Of course, you wouldn't know what your allowance is going to be, so how could you record your sale? Okay, so it's allowance. Okay, good. Sales on installments. Buyers, if you can estimate collectability. Now, here's the problem with this one. And just in general, know this. If you're not going to get paid, you do not have a sale. How many of you agree with that? You just gave them the stuff. So what you do on the installment is you might use the installment method to record the sale, which means I won't record the sale until I get paid that portion. And as I get paid, then I'll recognize that portion of the sale and that portion of the cost of goods sold. Do this at a later cost. Okay? And so you recognize your gross profit over the time that they pay you. There's another one, cost recovery it's called. We're really worried we won't get paid. And then if they pay us, we recognize the cash received as a debit cash credit sales, and we recognize cost of goods sold exactly equal to it. So what's our gross profit while they're paying us? Nothing until we recover the full cost. That's why it's called cost recovery. And then after that, it's all profit. Because we're not even sure they're going to pay us the full cost of it. Got the idea? And the profit just comes at the end after they pay everything off. So, there's ways you can be more conservative about this. Some of That's what that's about. Okay? Good. So read through this stuff. Think about it. Ask a lot of questions about inventory on the CPA exam. Obviously, the two chapters are going to ask you a lot of stuff. You know the difference between product cost and period cost, right? Product cost includes what? From what counting 102 and counting 215 if you've done it. Guess what product costs are? It's not a product. You're manufacturing your stuff. What is it? Yeah, direct materials, direct labor, and all the overhead that you apply, right? You guys know that. Or the product cost by buying it from somebody else, it's just the merchandise inventory itself, right? Which is their product cost added up, of course. Or plus their product. What are period costs? Operating expenses, selling, general, administrative, right? They're what? Costs that are incurred in the current period, right? They're not related to the product. So, okay, product costs obviously inventory. Period costs are not. Okay, so they do mention on page 426 the FASB rule that companies capital interest costs related to assets constructed for internal use or assets produced as discrete projects, ships, real estate projects for sale or lease. So even inventory, it's really big projects. How about if I'm building houses? Construction period interest is part of the cost of the house. Got it? If I'm making a ship or something, the cost would be there a bridge. Okay, that's the deal. What do you typically do with all the interest? Interest that is not related to the construction of a major project. What would it be? Period cost is expense. Yeah. So that's why I made me point out that. This on page 427, handling purchase discounts. We did sales discounts is exactly the same. The two methods are what we just in mirror image. What are the two methods? Gross and net. Right? Remember we did that with the sales? So take a look at that. If I give you a problem like that, celebrate. Okay, they're really deep. And notice on page 427 they have purchase discounts lost instead of sales discounts lost, right? Which method would you probably use if you're doing purchases? Would you probably use the gross method or the net method, folks? What do I want to know about? What do I always do? I'm buying stuff. How many times do I pass my discount on purpose? Never. So what would I expect? If you were my employee, what would I expect to have happen if you're handling my taxes on my payments? You'd always pay exactly in the credit terms the day it's due. You always take the discount with you. So which ones do I want to do? I want to see how big the discount is, which would be the gross method, or do I want to see how big the discount loss is? I want that loss. Right? That helps me run my company. On sales, though, it's the exact opposite of that. Now I want to know how much the sales discount is possible. Right? More or less. So do I still keep track of the other side of this in terms of, how much did I negotiate for? Sure, you can keep track of both. Okay? Alright, fine. Alright, which cost flows? Specific identification, average cost, FIFO, LIFO. What's specific identification? And it's professional periodic, right? We did that when we were doing chapter 3 again. You did it in principles. We know periodic versus perpetual, but there's also within that FIFO, LIFO, and average, right? Okay? So, which is best? There's also specific identification. That would be each inventory item itself would identify a particular one. You know what, if I was selling 747s, I think I'd use specific identification. They're all different and they're real expensive. How about really expensive diamonds? It's 20,000, it's 100,000, 250,000. I think I care which one's which, right? I'm going to do each one, identify each one. But here's the thing, everybody thinks, oh, specific identification would be better. And ordinarily it is, right? Because you get the right cost with the right sale. Make sense? But here's an example where this can backfire. Warehouses really like specific identification. Why would a tree company, tree and paper company, like specific identification? Because they can pick what they sell. They own timber they bought in the 1930s. They didn't pay much during the Depression. So if they don't have enough income, what can they do? Cut some and sell it. And their cost of goods sold is almost nothing, and the sale is almost 100% profit. What if they have too much income and they'd like to show a little less? You know what I'm saying? Smoothing? Only this isn't smoothing because they're using specific identification, so it's what it costs, right? What do? Use some recently purchased things, right? It costs a fortune. Make almost nothing off of it when they sell it. Does it really change what happens to them economically? No, our sales are what they are. Their cash flow is what it is, right? But boy, it impacts that income statement. So this can backfire. Now, does that mean they're doing something wrong? No. They're following GAAP. I don't know if I can even argue it's wrong. I mean, it's specific identification, isn't it? Okay? So anyway. That's one issue, I guess. So other than that, which is better, just go FIFO, LIFO, or average? I don't see much rationale for average in general. You know what we always say with average? We say average, or use average, moving average, or weighted average. When would you use moving? Perpetual or periodic? Perpetual, right? If you're perpetually keeping track of it, so the average moves every time. But you need to notice, you already did it too. Okay? When would you use weighted average? When you're periodic, because you buy everything before you sell anything, you have to do the weighted average first, right? And your inventory is valued at the weighted average, your cost of goods sold is valued at the weighted average, okay? But average, always you say we use average which approximates FIFO or average which approximates LIFO. Does it really approximate it? Not really, but average is easier to use, okay? I said that on tape, okay? Don't write that on tape. Okay, but you know, it sort of approximates it. But you have to use either FIFO or LIFO under GAAP. You can't really use average, so we say it approximates it, right? So tell me this, which is better, FIFO or LIFO? Depends what you want to do, huh? Okay, and they go through a number of advantages and disadvantages. Let's see. Come back to LIFO. Okay, back on page 440 and 441, 442, it goes through these advantages and disadvantages. Wouldn't it be cool if I gave you an essay where you got to list all these advantages and disadvantages for me and discuss it? That'd be fun. Okay, comment on this. Okay, so comparison of the approaches. All right, what is the deal with LIFO? What would be an advantage? What's the big one? Taxes. Would you rather pay more taxes or less taxes? Less. That's the deal. Okay, that's the big advantage of why people use it. But there's more. What about the matching? Well, I tend to be expensing things what? Current revenues create transitory or paper profits, inventory profits. That's true. Right? If you use FIFO, which ones are you putting on the income statement? Which costs? Which costs get sold in FIFO? Which costs? Old ones or new ones? Old ones. First in, first out. Might that be making your cost of goods sold look too low compared to what you can replace the inventory for? Yes. That's the argument. Got it? That's the argument. So maybe LIFO's better for matching revenues and expenses, huh? Makes it look more realistic. Okay? Everybody good? Because it's more recent costs. But what you're doing is you're screwing up the balance sheet more and more and more each year, right? Because you got older and older goods sitting on the balance sheet. But it makes the income statement a little better each year. So which would you rather do? Have small errors on the income statement year after year after year, and have the balance sheet have a more realistic number, which is FIFO, right? More recent costs on the balance sheet. Or would you rather have the balance sheet get worse and worse and worse, but have the income statement better? Which is better? Which one do you want to screw up? And that's an interesting thing to ask, isn't it? It's sort of like the allowance for doubtful accounts and the bad debt expense, right? You're estimating, and one thing has to give for the other. Either the allowance is going to be the number we want, or bad debt expense is going to be the number we want, but rarely are they both the number we want, huh? What was my preference? I like the allowance to be better. You know why? Because if bad debt expense is screwed up a little, I get to close it and start over. If the allowance is screwed up, what's the deal? It stays screwed up. You have to fix it later. Everybody got it? So that's just personal preference, though, right? There's nothing simple about it. Okay. So matching, tax benefit, improved cash flows. Okay. Future earnings hedge. I love that one. On page 442. Future earnings hedge? What? I'm going to have more future earnings because I have less earnings now under LIFO? That's kind of true, but what does that sort of sound like? Smoothing?
a reserve for the future. Well, I don't like that argument very well, but that's one we use. Okay, so it is. It's a future earnings hedge. That's true. What's the disadvantage of LIFO, of course, relative to HIFO? You show less income. So if you want to manage your stock price up, what do you want to do? Show less income or more? Duh. I don't want more income. What's the cost of using LIFO? You have less income. So we have a way around the LIFO reserve. Okay? We still use LIFO, but we tell people what income would have been if we were FIFO. So they can compute it for themselves. So we didn't violate GAAP because we're still using LIFO. We didn't violate tax law either. Right? Everybody good? So we'll take a look at that. That's where that came from. And then obviously the inventory is understated compared to year-end prices, right? The LIFO, well, it's understated with what? Inflation. It'd be overstated with deflation, right? But it's still misstated, okay? Physical flow, do people, this is the biggest one, do people really sell the new stuff first and keep the old stuff? It's a dairy. Been in business 100 years. Yeah, sure, you're keeping the old stuff. No, nobody does this, right? Okay? I had a friend who did it a couple times that had this. Say, well, what about antiques? Well, maybe, right? Maybe. But typically, you don't keep the old stuff, do you? Try to get rid of the new car model comes out, or trying to get rid of the old ones. So it doesn't match physical flow. Inventory liquidation, poor buying habits. Now that one's kind of interesting. I don't want to liquidate the old inventory. Right? So I have to do what? Let's start dipping down into that inventory. That's going to give me lower cost of goods sold. More income, I'm going to pay more taxes. So I am tempted to do what? Keep my inventory levels where they're at. I don't want to reduce them. What do you think of this? I am intentionally keeping more inventory maybe than I need. And explore it. Right? The inventory becomes obsolete, gets damaged, I have to pay storage costs, I have to pay tax on it in some states. Get the idea here? I'm doing this on purpose? Yeah. So it encourages people to do things that are not economic in general. So poor buying habits as a result of that. And when we brought in the just-in-time inventory, a number of years ago now, when we went to just-in-time, this was a big problem for companies that are on LIFO because what happened? Just-in-time dramatically reduces your inventory. You read about that in 102, and you read about it in 215. Just-in-time is what? I want my supplier handing me the inventory as I'm ready to hand it to my customer, right? And the flow is great for logistics with UPS. They always advertise it's the full thing, right? But people can deliver the product to them and they can ship it to your customer almost instantaneously. Or you can even have, Amazon.com does this a lot. They'll have the thing shipped to you from their supplier, won't they? You buy it from them, and it's shipped to you directly by their supplier. They never touch it, right? They buy it when they sell it to you, instantaneous, the same time. How much inventory do you carry for that item? None, right? What's your inventory carrying cost? Nothing. It's nice, isn't it? Okay, so you get those types of things set up. But you can imagine if you had a big inventory, now you get it down to nothing, what happens to you? If you were LIFO, pay a bunch of taxes down. Okay, so that's the deal. And then take a look over on page 445. I mentioned this to you earlier. This repeal LIFO, this evolving issue in the yellow there, right? Purple and orange and yellow. Did you take a look at this? There's arguments consistently. The White House always wants to repeal LIFO. Congress never does. Why? The White House would like to see all those dollars, right? Congress would not want to. But their constituents don't like this. Why? They'd have to pay the tax. So if you got rid of LIFO, there's $61 billion at the time this was done in 2009, estimate. Way back in 2009. Double now maybe. $61 billion in additional tax collections if you just got rid of LIFO. Are we going to do it? Oh, by the way, what's the other thing that would happen? We'd match IFRS. Nobody else in the world has this ridiculous LIFO thing, just us. IFRS says there's no such thing. I think that's probably right. I think it's probably right. I like it. But do we really have to get rid of LIFO to quit using it for financial statement purposes? Of course not. What could you do? What do you do for depreciation? For depreciation, you use modified accelerated accelerated cost recovery system, very rapid depreciation, don't we, to save tax dollars. But that's only on the tax return. What do we do in the financial statements? Usually straight line, a reasonable life, right? Or even if it is a declining balance, much slower than the modified accelerated cost recovery system would be, right? Okay? So, do we use different methods for tax and book? Yes. Could we for this purpose too? Yeah. Nobody ever talks about that. Of course we could. You can let people use LIFO for tax return and use FIFO for financial statements. Big deal. But do we want to let France? It's not really all France. It's the whole world. There's 100 countries that are using IFRS. So we got the French, right? Do we want them to tell us what our tax law should be or what our GAAP should be? U.S. Congress? Oh yeah, that's going to happen. So this is hanging us up from adopting IFRS. You'll probably get a question like that on CPA exam. What are the major stumbling blocks, right? This is the big one. And so that's what they're talking about. So read that. Okay, I want to get a couple more things. You guys are acting like you're bleeding. Don't do that. Okay. Things are out of time. Let's talk about LIFO reserve. Okay? Over on page 432 and 433. What is this? This is so cool. LIFO reserve. Companies are using it at the bottom 432, special issues related to LIFO reserve. Many companies use LIFO for tax purposes and external reporting purposes. However, they maintain a FIFO average cost of standard costing system for internal reporting purposes. Why would you do that? I want to know how much inventory I've got and what it really cost me. What's going to give me a better representation, FIFO or LIFO? FIFO. Yeah. Okay. So companies often base their pricing decisions on FIFO average or standard cost assumptions. Well, that would make sense. They did it based on LIFO. These are old costs and you wouldn't charge enough to make any money. So yeah, of course like that. Okay? Record keeping on some other basis is easier because the LIFO assumption usually does not approximate the physical flow of the product. We do that. Profit sharing and other bonus arrangements often depend on the non-LIFO inventory assumptions. You can find out how much money you really made, right? Not what you'd like to show in the tax return. Okay? The use of a pure LIFO system is troublesome for interim periods, which requires estimates of the year-end quantities. So people use a LIFO reserve and then report the financial statements at LIFO for inventory and cost of goods sold. But they use a reserve to get there instead of maintaining their inventory at LIFO. They maintain the inventory at average, perhaps, or more like FIFO. Got it? See the book. That's the whole point with this. Okay? So here's an illustration on the top of page 433. Take a look at this. By the way, with inflation, what's this reserve going to look like? This allowance or reserve. What's going to happen to cost of goods sold? LIFO compared to FIFO. You're keeping your records at FIFO. And now you're making a journal entry to convert effectively to LIFO. Is it a debit or a credit, the cost of goods sold? It's a debit. Why? Because you're reducing your inventory. It's a debit to cost of goods sold and credit to inventory, isn't it? To go from FIFO to LIFO, assuming inflation, right? Assuming there's inflation. There's typically inflation report. Okay? But they don't go to inventory. They go to allowance to reduce inventory to LIFO. Why would you want to do that? Sure, you can show your inventory at FIFO and then subtract it by the allowance and get down to LIFO. Got it? Okay. But it gets worse. Read these notes. Note disclosures on LIFO reserve. It says companies should either disclose the LIFO reserve or the replacement cost of the inventory. So here's American Mass Products. Note 3 inventories. At December 31st, 31 million of inventories were valued using the LIFO method. This amount is less than the corresponding replacement value by almost $4 million. So they let you know what the replacement would be. You got the idea? Okay, so you can compute what net income would have been. Right? If you're using that method. And then on brown shoes, the same thing. Inventories are valued below determined principally by the last half method. If FIFO were used, inventories would have been higher the current year and higher in the previous year, and you can convert your income for each of those years to what it would have been under FIFO. Got the idea? So it allows analysts to do that, and of course they do. Okay. So what kind of a journal entry are you going to make there? Be careful. What kind of an account is cost of goods sold? Temporary or permanent? Real or nominal? What is it? Cost of goods sold is nominal or temporary. Got it. Right? Sure. What do you do with those accounts? Close them and start over. Okay, so that's what you do with that. I want to get the income statement. Allowance. An inventory reserve. Allowance. To reduce the LIFO. What about that account? What kind of account is it? I'm going to show inventory less the allowance. It's just like allowance or doubtful accounts. Just like the allowance, returns and allowances we talked about just now, right? It's an allowance account. What financial statement does that thing go on? Is it real or temporary? It's real. It's permanent. It's real. It's an allowance. It's on the balance sheet, isn't it? Same with the current assets. Everybody got it? Are you going to close that one? No. So listen to this carefully. When you make a journal entry each year, are you going to create a new allowance or just adjust the one that's already there? Just the one that's already there. Right? So you just adjust from where it is now to where it needs to be. How do you know where it needs to be? You've got your inventory at LIFO. You've got your inventory at FIFO. Take the difference between them, and that's what you want the balance to be in the allowance. Right? That's it. Take the allowance from where it was last year and adjust it to where it needs to be this year, and you've done it. Right? It's going to either be a debit to the allowance if the inventory is declining, right? Or it's more likely going to be a credit to the allowance because the inventory is going up, right? Or there's more inflation. More likely to be credit to the allowance. What's the debit going to be? It's going to go where? Cost of goods sold. That's it. Okay? But remember it's adjusting, and this is a real common question, and people miss it over and over and over. I know because I put it on quiz and test, right? But I bet they do it in the CPA exam too. They suck you into doing the whole thing, right? If it's the first year, it'd be the whole thing. It's just like allowance for doubtful accounts, right, X? You don't debit expense for the whole allowance every year, just for how much you add to the allowance, right? Good. Got that? We're doing it. You guys are awful tired. It's probably reflecting me. Okay. Let's take a look. I think I got everything I wanted to do. Not that I want to read all. Turn some high points. But let's do this. Let's take a look at some more errors. Let's go to exercise 8. And they have some problems in here that are errors if you were using periodic and errors if you were using perpetual. What's going to be the big difference? Periodic, debit purchases when you buy it. Don't record the cost of goods sold, right? Calculate it. Perpetual, debit inventory when you buy it. When you sell it, credit inventory and debit cost of goods sold. So read if it says it's periodic, if it says it's perpetual, that's a whole different world. Okay, it'll change the accounts you're using. Okay, so take a look. Everybody take a look on exercise 811 on page 455. Okay, this is another inventory errors. At December 31st, Stacy McGill Corporation reports current assets of $370 and current liabilities of $200,000, right? The following items have been recorded incorrectly, and then down at the bottom it says, compute the current ratio based on their balance sheet, recompute the current ratio after corrections are made by what amount will income before taxes be adjusted up or down for the corrections. Oh my gosh. How do you approach this thing? They've got 4 different items here. What are we going to do? What would you do? You know what the current ratio is now. It's 370 divided by 200, right? But what would happen? What do I want to know? Current ratio is just current assets over current liabilities, right, everybody? So what is it right now? Let's calculate.
370, was it? 370, over what? 200. Is what? 1.85 to 1, right? That's your current ratio. And all I want to know is, what would it be if you do all these things? Well, what do you care about? What current assets change and what current liabilities change? But how do you know? I think maybe a journal entry. Goods purchased costing $22,000 were shipped FOB shipping point by the supplier on December 28th. Okay. Stephen recorded the invoice on December 29th. Sounds fine. But the goods were not included in their physical inventory count because they were not received until January 4th. What's the key issue? Whose inventory is it? These were not included in inventory. Whose inventory was it? How do you know? How do you know? Yeah. Okay, so who's it being shipped to? Did we sell these or purchase them? Now that makes, you're right, both things matter, right? If it's FOB shipping point and I shipped it, whose are they? My customers. If it's FOB shipping point and it's being shipped to me, whose is it? Mine. Okay, so what do I want to do with this? Debit what? Inventory, right? Everybody agree with that? Because I waited till next year, and it's mine now. Debit inventory for 22. But be careful, there might be more. What's the credit? This is why journal entries are so nice, right? You can't screw up. Because you could easily just say, oh, that should be added to current assets. Yeah, that's true. But what else should it be added to? Current liabilities. Named? Account payable. Sure. I'd just write the entries if I were you guys. You can do a T account if you want, for current assets and current liabilities, and add and change the things you got from each. I don't care. Okay? But that's 22,000 added to both, huh? That changed your current ratio because now we got 392 here and we got 222 here, right? I don't think we need to do it until we're done. Probably didn't tell us to, so after the corrections are made. Let's do 2. Goods purchased costing 15,000 were shipped FOB destination by a supplier on December 26th. They received and recorded the invoice on the 31st, but the goods were not included because they were not received. It's FOB destination. Should we have recorded this in our inventory? No, it's not ours. Should we have then debited inventory and credited accounts payable, which obviously we did? No. We don't do it till we get them. Let's be careful with this one. How would you fix it? They should not have recorded. I agree with that. Agreeing with myself, I guess. Did what? Debited inventory, right? Credit accounts payable. Should not have done it. So we just reverse that? What's the problem with that? You guys just want to reverse it? What do you think? 15,000? 15,000. Well, do you want to get rid of the account payable? How many of you want to get rid of the account payable, seeing we don't owe the money yet? Hope that's unanimous, huh? Okay. So let's make our adjusting journal entry. This was an adjusting journal entry too. Debit what? Accounts payable. What do you want to credit? Be very careful. Do you want to really reduce the inventory? What did they do at the end of the year? They counted the inventory, didn't they? Were those there yet? No. Was their count wrong? No, it was right. You don't want to credit inventory, you'd make it wrong. What do you want to credit? Cost of goods sold. Beginning inventory. Plus purchases. Available. Less ending inventory. what? Cost of goods sold. It is, isn't it? Beginning inventory is probably okay, huh? Ending inventory is probably okay, huh? What's wrong with purchases? Too high by 15,000. What's wrong with available? It's too high by 15,000. What's wrong with ending inventory in the balance sheet? And on the income statement, cost of goods sold, nothing. What's wrong with cost of goods sold? Too high by 15. Guess what the credit is, you guys? Cost of goods sold. Be careful. Would you got sucked in on that one? Yeah, people do all the time, right? So now we got two of them, and that did not change inventory, right? Didn't change current assets. It changed just accounts payable. Third one, goods held on consignment from these guys were included in our inventory. Physical count in the inventory of 13,000. They're on consignment from them. They're not ours. Should they have been in our ending inventory? No. So what we did was we overstated the ending inventory, and we did what? As a result? Understated cost of goods sold and overstated net income, right? Okay? We overstated the inventory. Everybody agree with that? Is that what happened? It's not our inventory? Okay, because there's no account payable going on there. So how would you fix that one? I think this one is a credit to inventory, right? Shouldn't be our inventory, and it's a debit to what? It's got to be cost of goods sold, okay? So that one's going the other way, and that's how much? 13,000, just like that. Okay, so we've got that one. So now we've got three adjusting journal entries, huh? And what's the fourth one? Freight in of 3,000 was debited to advertising expense. What does that do? They debited advertising expense and freight in. Freight out is what? A selling cost. Freight out. Selling cost. It's an operating expense, right? Cost of distributing the product. What's freight in? Part of the purchase price of the inventory. So this should have been debit what? To fix it, what do we do? What should we have debited? Instead of a administrative expense, what should we have or advertising expense, what should we have debited? Inventory should have been increased by 3,000. Our ending inventory is wrong because we don't have it included in it. And what would we credit? The freight on goods is part of the inventory. Advertising expense, I don't care about the advertising expense, but I do care about the inventory, don't I? So what's our numbers, guys? Let's do them real quick. 370 plus 22, right? Less 13. So what that's 379 now? Plus 3, what do you get? What's the current assets? Yep. 370 plus 22 less 13 plus 3. 382. That'd go to 382. Okay? Current liabilities were 200. What do we do to them? Increased it by 22. There's 222. And then decreased it by 15. So we're 207, are we? And that was it? What's 207 into 382? Could you do this? I hope so. Okay? So even if they make it look a little different, that current ratio, it's all right. Don't fine. See you guys. Work, work, work.